But lots more earnings, so let's address another set. We've got the Blue Star management joining in. Advani, the MD at Blue Star, joins us on the show. Mr. Advani, hi, morning. Tell us about what are the factors that impacted your headline numbers and led to a loss. I mean, aren't the GST worries now behind you?
Good morning. Thanks for having me. Let me walk you through the numbers. I think as far as revenue goes, we had a strong quarter, about 18% growth. So we don't see any challenge as far as demand is concerned. Both segments, our projects business as well as our unitary products business, both grew well at the top line. We have had challenges at the gross margin level. I think that's been across the industry, input costs going up, plus due to inventory pile up in the room air conditioner business, we've had to liquidate inventory at lower prices. So gross margins have impacted the overall performance. You can see that at the EBITDA and PBT level, we are flat over last year. That's before exceptional items. So that's as far as the operations are concerned. We had two exceptional items in the quarter, which is what has led to the small loss that we had. One is our Platinum Jubilee expenses, about 7 crores for the quarter for our 75th year celebrations, which will now not be repeating as we go into next year. And the other larger one is a provision that we've taken on a joint venture we have in Oman. We have decided to exit that joint venture and prudently have provided the entire financial exposure in the quarter. So due to those two exceptional items, we've had a small loss for the quarter, and obviously we're looking to recover as we go into Q4.
Okay. Margins have come in flat this quarter. What's the reason, and when can we see a pickup in margins?
Sure. So in segment 1, you can see a small drop in margin. That is primarily on account of input costs going up, which is again across the board. The dollar has moved up, and because of that, some input costs are up. In segment 2, margins are lower, and that is primarily due to price reductions in the market. As we've been saying, there was a poor summer this year in the room air conditioner market. Because of that, there was inventory piled up across the industry, including with ourselves. All of us have been making attempts in the last 6 months. Typically this quarter is a very low season for room air conditioners, but we wanted to clear out our old inventory and get ready for the new summer season that's starting right now. So we did have to deeply discount our products just to liquidate them. There again, we feel going forward into Q4, I think the Q4 margins should be considerably better, having cleared out the inventory, and we're now fresh into the market. So on an aggregate basis, we see margins improving from Q4 itself, and are fairly optimistic about FY20.
Okay. Also wanted to understand really, where exactly is the profitability for EMPS, because that was impacted, as we understand, because of the increase in material input costs. When will the profitability finally recover?
So if you look at it on a YTD basis, we're at about 5% EBIT, and that's what we have been signaling to the market, that we should expect around 4.5% to 5% EBIT on a YTD basis. As you know, the projects business is a lumpy business, depending on quarters where we close projects or we bill certain types of projects. You will see the margins moving up and down. We're not untowardly worried about the margins for the quarter in segment 1. I think you need to look at it on a YTD basis, and we're doing okay, and we will end the year also at a healthy level. So as far as that business is concerned, I'm happy to report that order inflow is up 21% in the quarter. On a YTD basis also we're doing quite well. So we're winning in the market, we're winning market share, which is a positive thing, and we hope to continue that run. The other positive thing in segment 1, as you know, we have our central air conditioning business there as well. That's the equipment business, chillers, VRFs, ducted systems. We've had phenomenal growth there, ranging between 18 and 30%. We can see a lot of customers moving back to Blue Star as a brand in the central air conditioning equipment business.
Okay. What are you aiming for by way of growth, interest in terms of pure growth on the top line and the bottom line over the course of the next 2 years?
So we remain focused on growing our bottom line faster than our top line. So we're looking at growing our top line at about 17 to 18% annually, and our bottom line should grow by more than 25% every year for the next few years. Of course, this year has been a tough year, is a tough year that we're going through. There's been the summer, there's been the NBFC issue, we had the dollar fluctuating in between, so it is an industry phenomenon that we're also experiencing. We are expecting that with a normal summer coming up, we should get back to our normal run rate of growth, which for the last few years, as you know, has been about 18% top line, 25 to 30% bottom line. So I think on a strategic level, we're very clear about the direction we're headed in, and there's been no fundamental change in the market or in our competitive position in any of our lines of business.
Right. The industry right now is witnessing a growth and perhaps should reach a size of about 500 crore rupees by 2021 from the present 180 thereabouts. How is it that you plan to capitalize on this kind of phenomenal industry growth?
I'm so sorry, which industry are you referring to? The 180 and 500?
No, I'm talking about your industry.
180 crores, I'm not sure. If you're talking about the air conditioning industry, it is obviously much larger. It's about 18,000 crores. So if you're referring to that, I think we're looking at industry growth of about 8 to 10%. Again, this year, of course, has been a degrowth in the industry overall, as you know. But I think going forward, looking at the penetration levels, looking at per capita income moving up, we're fairly confident that an 8 to 10% industry growth should be doable, and we as always strive to grow by at least 5% more than the industry, and that's why I gave you an indication of about 17% is what we would like to see as a stretch goal for us. Of course, we do know that as per capita moves from the current level of $2,500 up to $5,000, we should see an even faster uptake in the industry growth. So 8 to 10% may have been industry growth between 1,500 to 2,500 per capita, but hopefully we may be seeing a faster growth rate. But what works against that growth rate, as you know, is that there is a lot of pressure from the government on energy efficiency regulations. So as energy efficiency regulations come in, it tends to push up the cost of the products. Of course, manufacturers like us are always looking to optimize that and bring it down for our customers, but it isn't always possible. So you will be seeing an increase in cost going forward on account of energy efficiency, because of which some of that growth may be dampened, which is why I'm indicating maybe an 8 to 10% industry growth.
I think I skipped to zero there. Thanks for correcting me on that one. But great speaking with you, Veer. Thanks so much for joining in.
Yeah.
Okay.
Thank you.
That's the word coming in from the Blue Star management. What about the market? We've given up that 11,000 mark, still holding on to a gain of about 0.5%, but cooling off quite rapidly. And the broader market definitely is in the red, and well in the red, I should say. Almost a 1.5% gap between what the Nifty is doing and what the broader markets are up to. Quick break, lots more lined up when we come back.